There's not actually left much left for me to discuss from chapter 8, which is asset allocation. I in the preamble I've talked about a lot of things, and chapter 8 is actually fairly short, but there are a few things left to say. First, investors or researchers have been investigating asset returns for a few hundred years, and obviously we're all after ways to achieve high returns with low risk, and investors researchers have analyzed different trading strategies and things like that, and they've also tried to find the factors that drive returns. Like, what is it specifically about investing that's going to lead one person to doing better than another person? And they have found four factors that tend to drive returns. The first is cost. If one person invests in a mutual fund that charges high fees and another person invests in mutual funds that charge lower fees, that's going to impact the difference in one person earning higher returns than the other. Another factor is market timing. There's actually a chapter on this, or actually a portion of a chapter on this, but if you can time the market and be in the market when it's rising and out of the market when it's falling, so you wouldn't be losing returns, that's obviously beneficial. We'll talk more about that in I think it's chapter 13. Another factor is individual security selection, what they call, they don't actually call it this in the book, but you'll hear it called tactical asset allocation in certain circles. So, specifically, which stocks do you choose to invest in? Which bonds do you buy? And I don't mean by asset class. I mean, do you buy stocks in Apple, Ford, and GM, or do you buy stocks in Krispy Kreme, Volkswagen, and gosh, I can't think of another company. I don't know if I said IBM already. So like it's very specific. Which company's stocks are you purchasing? Which company's bonds are you purchasing? That's what I mean by individual security selection. That matters. But it doesn't matter as much as this last factor, and that is what they call strategic asset allocation. And that's your book just called it asset allocation, not strategic asset allocation. But that is how do you allocate your money across the broad asset classes? There's three really, really broad asset classes, and that's cash, bonds, and stock. And so let's say person A decides to do 90% cash, 10% bonds, and no stocks. And person B decides to do no cash, no bonds, and 100% stocks. And let's say this is a long term investment, they're saving for retirement. Person A is going to be so much better off. Sorry, person B, big difference. Person B is going to be so much better off simply because they have chosen to structure their investments in a completely different way in terms of the asset classes that earn the higher returns versus the asset classes that earn the lowest return. This is the biggest driver of performance compared to all those other things. Um, it drives about 90% of your performance, actually a little bit more. I think it's more like 94% of your performance is determined in a very broad sense based on which asset classes you choose to invest in. Are you putting your money in stocks? Are you putting it in bonds? Are you putting it in cash? Are you putting it in a mix of all of those? Or um, are you putting it mostly in stocks and a small amount of bonds? It all depends on what you should do. Depends on your a few factors. One of which is how old you are. How long is your investment horizon? How long will it be before you need to start spending that money that you're saving? But at any rate, strategic asset allocation is such a big driver. It's probably the most important decision you have to make as an investor. It's not which stocks you're going to invest in. Is it going to be Apple? Is it going to be Microsoft or what have you? It is How much of your money are you going to put in stocks? Are you going to put all of it in stocks? Are you so risk averse that you're only willing to put half your money in stocks and you want the other half to be in safer securities? Well, if you do, that's going to make a huge difference in your returns. The and I know this is a very difficult decision to make. How do you know how much you should put in bonds? Well, it depends. So, when determining your asset allocation, I'm just trying to make my notes look good too, but maybe I shouldn't focus on that. So, when determining your asset allocation, you need to consider a few things. The first is your goal, your financial goals. How much money do you want to have saved up by X amount of time? What sort of return are you going to have to earn on that money to be able to accomplish your goal? If you can earn 3% and accomplish your goal, then that's going to make a big difference in which asset classes you need to invest in. But if you're going to need 8% to accomplish your goal, that's going to really impact how you should allocate your money across these broad asset classes. Also, your time frame. Now, I showed y'all a spreadsheet where we looked at the return of small cap stocks and large cap stocks and how over the long run being about a decade or more, uh, stocks tend to earn positive returns. That's a has a big impact on how you should allocate your assets. If you're saving money for your college tuition next year, I would never invest that money in stocks since there's only a year until you're going to need to spend it. And the stock market can certainly lose a lot of money in a year. Just look at 2008. If you're saving money for a down payment on a house that you expect to purchase within the next 4 years, let's say, again, I wouldn't put that money in the stock market. To me, my time horizon is so short. I'm going to want that money in 4 years. And if I lost 20% of it in a particular year over the next 4 years, that would hurt a lot. So I wouldn't put money that I'm saving for such a thing in the stock market. But if I'm saving for retirement, if I'm saving for something that I don't expect to occur for 15 years, even if it's just like, let's say I want to travel the world for a year when I retire, I and that's not going to be for 15 years, so I would invest that money in the stock market. So the time frame, the longer the time frame you have, the more you have time to recover from a loss. So that should suggest that you should be willing to take more risk when you're deciding on your broad asset allocation. And then your risk tolerance, which is a difficult thing to gauge. It took me a while of investing in the stock market to get a good feel for how much risk I was willing to take. If you can't sleep at night after you've made your investments because you're worried that you're going to lose money, then perhaps you're in too risky of a position and you should change it. And one thing that many people don't really know is how exactly will they react during a severe not bull, bear market. A bear market is a down market. It was 2008 when we lost 38% in the S&P 500. So during a severe down market, your emotions may be your own worst enemy. And what we saw was so many people just taking tons and tons of money out of the stock market when it crashed in 2008. And that was actually the best time to put money in the stock market. I have this Callan periodic table of investments, those returns that we were looking at in the previous videos. And you can see 2008 was just a horrible year for all of these indexes except those bonds. So foreign markets did bad, small caps did bad, but they didn't actually do as badly as large caps did. But generally speaking, the entire market was down. And tons of people just sold their stocks and shifted that cash into money market mutual funds, which earn very low returns, or even just put it in their savings account. But look at what happened to the stock market in the 6 years after the market crashed. So let's just look at, I guess I'll look at the S&P 500. So it crashed, lost 37% in '08, but in the 6 years since then, it's generated a positive return each year, and a couple of those years have been huge. So we've more than recovered the losses that occurred in 2008. But if you sold and you kept your money out of the stock market, you didn't reap that recovery. That's not good. So that's why it's really important to, gosh, stay the course, make your financial plan, decide how to allocate your money, and make sure that you're comfortable with the level of risk that you've taken and it's appropriate for somebody with your financial goals and your time frame and your risk tolerance, and then stick with your plan. Don't let your emotions impact your investing decisions, or at least try not to. There's an entire chapter on the psychology of investing at the end of the quarter when I'll talk about this some more. All right, that's actually it for chapter 8. I may think of a few other things to say about it, and I'll post those as announcements if I do.